I'm Sierra Fredrickson. I'm the operations manager here at XYPN. And today you are at Inside Experts, How to Niche in Company Equity with Kiersten Peshek. There are a number of paths to choose from when deciding how to niche in company equity. These range in complexity and skills required. This webinar will show you what applications you should consider to niche in this area. Kiersten will be fielding questions at the end of today's call, but if you have any questions throughout the presentation, feel free to pop those into the Q&A tab at any time, and we'll do our best to get to those at the end. And with that, Kiersten, I will turn it over to you.
Awesome. Thank you, Sierra. All right, y'all. As Sierra said, my name is Kiersten. I am recently a CFP as of June, and I use they, them, and she, her pronouns. I am a lead wealth advisor with Citrine Capital, and really our company does specialize in company equity as well as entrepreneurship. So this is something that I talk about day in and day out with my clients. And so I'm going to give you some insight into how to do that as well. Oop, going too fast. All right. So let me tell you a little bit about me here. I am a career changer. I moved from tech actually to financial planning full-time in 2021. I joined Citrine Capital as a paraplanner at that time, and I'm now a lead wealth advisor. My niches, so I said our company niches in tech and entrepreneurship. I also, so most of the people that I work with are tech professionals with company equity. I also specialize in LGBTQ+ planning, as well as FIRE planning. And if you're unfamiliar with that acronym, it is Financial Independence and Retire Early. So that is where I specialize. Prior to kind of getting into the financial planning industry, I was a tech professional, as I noted. I also worked in real estate appraisal servicing and loss mitigation for mortgages. And while I didn't know it at the time, it turns out all of those jobs kind of lend itself to helping me as a financial planner. So that is kind of my journey of how I got to where I'm at today. Today, we have a couple things that we're going to talk about. We're going to do an overview of planning for company equity. So some considerations, some things you should think about if you're going to go into this area of planning. I'm going to talk to you about the tools and documents that you need to ask for from clients. And I'm going to show you those tools and documents. So we're actually going to do a walkthrough of some of those things. And then we're also going to take a look at a case study of a client I made up. So that's what we're going to look at there. And then if you have questions at the end, I would be happy to answer those when we get there. All right, so planning for company equity. There are certainly a number of considerations that go along with this. The first thing that you want to start with, or that I typically start with, is what type of equity does the client have? I've put a couple up here. There's 4 here, which I will describe to you so you kind of have an idea of what this is. But please know that there are many variations of company equity. And in fact, I brought on a client last year who had a program I had never heard of. It was for their leadership at their company. So oftentimes it's good just to read through, the plan documents if you're not sure what program they have, and gather kind of all the information you have to learn about the type of equity that they are being granted. All right, so the types of equity. Restricted stock units is the first one that I've got up on here. These are granted to employees. They don't have to pay anything for them. They typically vest over a number of years. Most often what I've seen is 4 years, but they vest, the employee doesn't have to do anything. They're taxed when they vest. And then that employee can make decisions around if they want to hang on to them or sell them. But that's pretty straightforward. Oftentimes we like to think of those as like bonuses. The Employee Stock Purchase Program, or ESPP, is a program where employees can purchase company stock at a discount. That discount can range from 0 to 15%. Most commonly, I see a discount of 15%. But you may see differently. So I like to call out that there can be a range there. So that is that program. We also have incentive stock options and non-qualified stock options. These have different tax treatment, but the concept for them is pretty similar. The employee is given the right to purchase company stock at a specified price. So that, there's some benefits between one versus the other. We can talk about that. But that is the basic premise, is you have the option to purchase equity at a specified price. One thing I like to call out here, each type of equity has its own tax consequences to consider. This is really important, which is why I put it on here. You or your CPA or enrolled agent has to be very familiar with these tax consequences to niche in this area. Part of I'd say a big chunk of our strategy around company equity is talking and thinking about taxes. One of the resources that I want to give you for that is mystockoptions.com. I really appreciate that website. There's a lot of information on there around company equity if you want to learn more, but they also dive into taxes. So one of the things that I will do if I'm calculating ESPP tax consequences, I'll just double check, right? Double check their website, their descriptions of how to do the tax calculation, because maybe that doesn't come up as often. So I really think that that is a good resource. But if you have a CPA partnership, or if you are maybe an enrolled agent or a CPA yourself, this is something you need to be very familiar with. At the same time, just to point that out, don't let the tax tail wag the investment dog. Diversification is the main goal when we talk about company equity. Taxes are important, but sometimes you have to talk a client, through that. We're not trying to pay zero in taxes all the time. So that is kind of part of the conversation you may have to have. Be familiar with it, but sometimes we generate taxes, and that's okay. All right. The second part here on considerations is really talking to the client about their perspective on their equity. This is really important, and every client is kind of different on this. There's been a lot of talk lately about behavioral finance, which I really appreciate. I think that is really important when we're working with clients, because that affects pretty much every decision that they make. And that is absolutely relevant for company equity. So what kind of behaviors is the client exhibiting around their equity? Do they want to diversify? Why haven't they done so yet? Have they not had the opportunity? If they had, are they unsure how or what steps to take? So there's quite a lot of kind of digging that you can do there, and that you should do there when you're dealing with clients and their company equity. I've listed out some kind of biases and behavioral things that I think are really relevant in this space. Familiarity bias here, investing in what you know. I think for clients who have been working for a company for a period of time, whether that's a couple of years or decades, it feels very familiar. If you spent a good chunk of your career in one place and you understand the company, you understand the product, and you feel very knowledgeable around all of that, then it can feel like, well, this is a safe place to park my money, right? In this one company. And so that bias does come up a lot. You're investing in something that you understand versus maybe something that you don't, like an ETF or diversified mutual fund. So that is something that you'll see quite a bit. We also have overconfidence bias. So the tendency for people to have more confidence in their own abilities, that comes up too. So, if they have had success with their company equity in the past, right? The company, we had a pretty lengthy bull market recently that, ended in 2022 there. And so really, if you saw kind of all of these positive returns with your equity, you've been holding on to it for a longer period of time, you may feel like, well, I made that decision. Right? I bought that equity. That was me. So I'm confident that I know if I keep doing that, it's going to be good. So that's, something that you may have to talk through as well. There's the emotional gap, right? A tendency to make decisions based on extreme emotions. And this, company equity is such an interesting space because wealth is built or can be built very, very quickly, right? You can go from 0 to 60 very quickly with company equity, especially if a company IPOs successfully or maybe has a secondary market offer where you go from having, 100K or 500K in net worth to a couple $1 million in net worth. That can really create some extreme circumstances where people have to make decisions around, do I keep, do I sell? How do I strategize around taxes for that? And it's challenging to make those decisions under that kind of pressure. We also, with this, some folks will start to make decisions preemptively. I have a previous client that happened to. Their company IPO'd and they were in a lockup period. And they, started to make plans, right? This is $4 million for us. Our lives are going to change. And, husband can be stay-at-home dad, and I'm going to keep working because I love what I do. And that was 2021, late 2021. So you can imagine what happened after 6 months, and we got into 2022 and the market did what it did. And those folks, all of those goals and dreams and feelings, they weren't necessarily possible in the same way that they were before because of what the market did. So again, extreme emotions. You've made these plans, these dreams have started to kind of come into your brain, and then maybe that doesn't work out the way you thought it would. So there's a lot of feeling there, I think, that folks are dealing with that we really have to coach them through when it comes to their equity. We also have self-attribution, so a tendency to make choices based on overconfidence in one's own knowledge or skill. This one, I actually think some folks will say, well, I work here, right? I know my team, we're a great team, I'm a great employee, I am affecting this, right? I have control because I work here. So sometimes folks will think about kind of where they are and their abilities and skills in their own job and say, well, that's going to affect the company, which means it's going to affect the stock price and we're going to do well. Not really considering things like market risk or any of that. So that's another one that you may need to walk through with clients. And then the last one I have here is loss aversion. And I think we saw a lot of that in 2022. If you have clients who had a 2021 stock price of $90 per share and now it's 30, it may be really hard to say, okay, yeah, I'm going to keep diversifying at $30 per share when I knew it was 90. So that can be really challenging for folks to still continue to diversify when they're seeing these huge kind of drops in their stock price and in their overall net worth in that equity. So these are all behavioral things that we need to work with clients on. And that can be, I think for some clients, really the most challenging part is getting through the emotional aspect of this equity, especially because, the numbers can be just so large. Part of what we do with this is use our financial planning software, which we'll walk through that in a little bit. But showing folks retirement and planning projections can come in handy here. If their company goes under, then they're probably in a worse position than if they diversify now at $30 per share. So there's some strategy there in helping clients work through that as well. Okay, all right. Let's talk about what you'll need. Let's talk about the tools and the documents, because that's definitely going to play a big role here in gathering all of your information so we can start strategizing around company equity. All right. So I'm going to talk about the tools that Citrine currently uses for equity planning. You do not have to use these tools, just to be clear. You can absolutely branch out and find other tools that do similar things. It's ultimately up to what you and your firm, what you want to do. But I am going to show you how we do it so that you get a feel for kind of what our process is, so that you can maybe iterate that into your own firm. So currently we use Google Sheets and Excel. I'll show you how we do that. That is kind of our data gathering space. We also use Holistiplan. The scenario analysis feature is incredibly helpful when it comes to the tax strategy. And as you'll remember, that was a very important bit of this, the tax strategy. We also use Right Capital, so that is our financial planning software. And then at the end here, you can see we have an in-house CPA. That was actually recent. So we hired Todd back in November of 2020, and that's just where our firm is at. So we do have that resource, but it's not necessary. If that's not where you're at with your firm, you certainly don't need to do that. I've put some alternatives here as well. So we have the ESO fund AMT calculator. This really comes in handy. It will calculate the alternative minimum tax for you based on the exercise of incentive stock options. So those, when you exercise them, have AMT tax consequences. So that calculator can be helpful. It's just on the internet, it's free. So I kind of like to call that out as a resource. Some folks, I have some advisor friends in the past who have actually just custom built kind of like a holistic plan scenario analysis, but in Excel. If you feel very Excel handy, you can absolutely go down that road. But you're going to have to update tax brackets every year and all the different things that change annually. So there's some pretty large man hours that need to go into that kind of a project. If that's something you're interested in doing, though, it certainly could be an option. Tax tools is another one. It's similar to Holistiplan, although from what I've seen, it looks like maybe it came out of the 1990s as far as website view, but it does function in a similar capacity as Holistiplan, where you can do these kind of scenario analyses and figure out the strategy around taxes for somebody's company equity. And then, of course, you can use other financial planning software, eMoney, Money Guide Pro. Any of that is just fine. It'll all kind of function similarly, but I will just show you Right Capital for today. Okay. Outside of the tools that we use, you also need to ask for some stuff from your client. And I'm going to go through kind of why that is the case as well. And then I'm going to show you some of these documents. I have redacted all of the sensitive information out of them, but I'm going to show you that as well. The documents that we ask clients for are grant paperwork for their equity plan document. So that really shows the whole equity plan for that employer specifically. And then an estimate of their income for the year. That one can be challenging when folks have company equity. If your stock tanks or goes to the moon in any particular year, you may need to be adjusting kind of consistently throughout the year on that estimate. But it's really important to have, especially when we're talking about tax brackets and the alternative minimum tax. All of that is affected by a client's income. So you do need that estimate for the year. So why do you need this information? I've just given you a reason for the income, but the documents will tell you quite a lot of information. You'll get kind of the number of options, RSUs, et cetera, that they've been granted. You'll also get vesting dates and vesting requirements, which vary depending on the company, depending on if they're public or private. There's certainly a lot of different ways that vesting can occur. We have expiration dates, and yes, some equity does expire. So incentive stock options and non-qualified stock options, those expire in 10 years. So, some clients may come to you at, I've got 6 months to exercise these options. What do I do? So they've waited 9 years and 6 months to make a decision, and now they need your help. So that's really important to be aware of that expiration date. Another one that's really important to be aware of is what happens to their equity if the client is terminated. Either they're laid off or they choose to quit their job, if they pass away or if they're disabled. One thing I like to call out here, especially under the termination one, is most often incentive stock options have a 90-day exercise window after you leave the company. That is not a long time. So that is something that we have in our leaving a job checklist or workflow for clients, is to check, hey, do we have 90 days? If we do, what are we going to do in that time period? I've seen exercise window as short as 30 days. Okay, so that you really got to get on that if a client quits and they've got 30 days to make a decision about their equity or lose it forever. And then on the flip side, non-qualified stock options I've seen as long as 7 years. Or the expiration date, whichever comes sooner. So there is that. But so that is certainly something that you need to be aware of if a client quits or is laid off from their job. That's a big one. And then the last one here, which you typically will find in like an equity plan document, is tax withholding details. And I put this sometimes in parentheses because an employer is not going to get specific, right? They're not going to say, okay, we're going to withhold taxes at this particular tax bracket, and we're going to list it out for all the states. They're not going to do that. However, what I do like about this and why I call it out is that sometimes they will tell you, hey, we're going to withhold shares for, when your RSUs vest, shares are going to be withheld for taxes. And then it's going to say, consult your tax advisor for more information. But I think it's helpful at the very least to know, hey, are they withholding shares or are they not? What have they written in that section about tax withholding details or taxes on a client's equity? So that is another piece of information that you would want to pull from that type of document. I will show you these documents when we look at around the time we look at the Excel or Google Sheet document as well, and I'll kind of walk through where some of that stuff might be. Okay, case study. Keep in mind, I made these people up, so these are very round numbers, obviously. So for our case study here, these folks are 35. We're assuming 2 people, a married couple. Their joint annual income together is $700,000. In this scenario, this is relatively new for them. They started vesting RSUs, and that has bumped up their income quite a bit, as we'll see shortly. Their overall net worth is about $1 million currently. And then I've also listed out the equity here. So this is their equity, and I've noted all of this has a 4-year vest schedule. That is not always the case. Some equity will have different vesting schedules, so just keep that in mind. It's good to check that in the documentation. Sometimes things vest immediately, sometimes they vest in 3 years, sometimes it's longer than 4. So just keep in mind that may change, but for our case study, everything vests over a 4-year vesting schedule. These clients, they have $25,000 ISOs, incentive stock options, and 15,000 of those are vested. They have 2,000 non-qualified stock options, 979 of them are vested. And then we have 10,000 restricted stock units, and 3,125 of them are vested. So that's kind of the basics there. The second bit here, let's talk about their net worth breakdown. The 401ks, they have about $150,000 invested in their 401ks. Vested company equity, this is a big one. We have just south of $800,000 in company equity here. And you may already be thinking, we have a problem. We do. Taxable brokerage account has about $50,000 in it, and then their cash is $10,000. So some initial concerns here. This is really as you're starting to kind of get the information from a client, you may start to say, okay, what are my initial thoughts around this equity? We definitely have a concentration problem here. So 80% of their total net worth is in one company. So certainly an issue that we're going to need to address. I also like to call out here that they have a really low cash reserve. So likely not enough money here to meet typical emergency fund requirements. Most of the clients that I work with, and this may not be true for y'all, but are Bay Area based, okay? And the cost of living there is quite high. So a typical emergency fund for folks there could be anywhere from $50,000 to $150,000. So 10K, definitely not cutting it for us here. The other thing that I did not write down here, but I think is worth mentioning is just the investments outside of the vested company equity we've got going on here. Are they saving enough, right? We're going to need to kind of run that analysis and look at, we've got pretty low 401k balance, pretty low taxable brokerage balance, and a lot of company equity. So are they saving enough for their goals? That's a big one too. All right, so let's get a look at how we are actually going to do this. I'm going to start out just by showing you, I've got this screenshot here of a example Google Sheet that we use. There are a number of things that I will point out here. We have a grant date. This is when the client was granted their options. We have the original grant amount, the shares that they may exercise. We are strategizing around that. What's left over there? The exercise price per share is in here. So that's how much the client has to pay per share to purchase these options. We have the fair market value at the time of exercise. This is the total cost to exercise based on kind of what we've entered in here as how many they exercised. We have a bargain element, and this is going to be, this bit of information is very important when we talk about the alternative minimum tax, because this is the adjustment that happens when you're calculating AMT. So we'll come back to that, but that's a very important piece of information that we use. And then, there's strategy around when do we sell and what's the sale price and all of that. So I'm actually going to switch my screen over here. So this is, we're in the spreadsheet now. And I'm just going to slide over here and show you kind of additionally what else is happening in this spreadsheet. And part of how we're using this is around strategy, figuring out taxes and all of that. Holistic plan is helpful for that. So is this spreadsheet. So we talked about, shares to sell, sale date, sale price, and then it starts to go into, here are your proceeds, here are your gains. So that's basically your proceeds minus your exercise price. And then it says, hey, have you held it for a year? In this case, if they did this in the way it says, then they did. And then it generates, calculates the taxes and proceeds after taxes and proceeds after taxes and exercise. This spreadsheet has a tax rates section, very simple. We've just listed out basically top tax brackets for this client, assuming that they are in the top tax bracket. And then that is what is then coming into here to actually calculate those taxes for this client. We also, so this is the incentive stock option section of this spreadsheet. We also have the non-qualified stock options, RSUs, and ESPP section. So that can also be, this spreadsheet can be used to strategize around that as well. The probably biggest question here is, where are we getting this information? And that is the documents that I told you guys about earlier. So we're going to pop over there for a moment here. This one, that's where I want to start. So I have, as you can see, redacted most of the or all of the kind of who this is, what company, that's irrelevant here, but this is a restricted stock unit agreement. So this is something that the client receives when they are granted restricted stock options. And really what I'm looking for here is all of the information I was telling you about before. So here's our grant date. This is when they received the grant. This is when the grant starts vesting. And this is the number of RSUs that they were granted. The vesting schedule for this particular person is actually outlined in Schedule A. So I'll pop down there to show you guys that. It just lists it out. There are other ways that they may list out a vesting schedule. I'll show you that on the other example that I have. So if we scroll down to Schedule A, you can see here's our vesting schedule. So I can tell that this client is going to get 623 RSUs every quarter, essentially from May of 2023 through February of 2027. So we've got pretty much a 4-year vesting schedule here for this client. So that is where I'm gathering a lot of this information to then put into my spreadsheet so I can start strategizing around the numbers. Clients will get a grant document like this for every grant they get. So when it's kind of all scattered around in all these documents, this is where the spreadsheet comes in handy. We're really just putting all of this information together, so we're not having to jump around from this grant doc to this grant doc to this grant doc to try to figure all this out. Okay, this one on the flip side is incentive stock options. So this client was granted incentive stock options, and this is the document that they were given when that happened. Again, where did I start to pull that information in from the spreadsheet? It's all kind of here at the top of this page. So we can see the number of shares, the grant date, the vesting date. This is not uncommon. You may notice they were granted in September and they started vesting like 6 months earlier. That does happen sometimes. So don't be too surprised if you see that. And then I called out earlier, they have an expiration date. So we need to make sure that this client takes action on these options before September of 2030. In this case, they've got some time, but even so, it's 2023 now. So, 3 years have passed. So certainly something that we need to continue to strategize around before that expiration date. We have the option exercise price. So this is what the client will have to pay per share to purchase these options. And then we have a vesting schedule. So previously it was just on the RSU agreement, it was just check out Schedule A. In this case, they're saying, hey, we're actually going to give you some detail about that. It's 1/48 per month for 48 months. And then it says there's no cliff. Okay. A cliff in this context essentially is If you are granted options and it says, hey, you have a 1-year cliff, and then it's 1/48 per month for 48 months, means if you were granted them in September of 2020, then you're not going to start vesting anything for a full year. So you will start receiving options in September of 2021 in that example. This person has no cliff. It's not an issue. As soon as they were granted, they started vesting. And this is not always the case, but they actually listed out the total schedule, which is kind of helpful here as well. And that just goes all the way through that time period. So that is all listed here. Then it tells you the type of option as well. So that's kind of where you start to pull that information. These documents you can see here, they tend to be long. There's a lot of information in here. But even right away, termination due to death or disability starts to describe what that means, what happens to their options if that happens, what happens if they quit, right? So all of that is in here for you to read, and is certainly important for you to read. So, all right. Okie dokie. So that is where we get the information. That is where we are organizing all of that information, is in that spreadsheet. That way, we're kind of bringing everything together. So we're trying not to, have to move from document to document to figure out where everything is. The next tool number 2, is Holistiplan. So we've gathered all of our information here for this client about their equity. And now we need to start to figure out how do we help them diversify, right? And what is most appropriate for them. With these folks, they have incentive stock options. So we need to think about AMT. So the screenshots I have here are the wages that these folks have. And then I've also put up a screenshot here of AMT. But we're actually just going to switch slides here and jump on over to the Holistiplan page so that I can show you this directly. So I've set up 2 years here. So we have 2023 as an example, and then 2024. So I can show you AMT versus AMT credit, among other things. Typically where I start here is to make sure that the income is set up correctly. So as I had in my screenshot, here are their wages. You can see we've got their salaries up here, and then we have their RSUs, which frankly is like 50% of what they're making this year is RSUs, which is why when I mentioned earlier, their income has gone up because of company equity. This is why the RSUs have made a very large impact on their actual total income for the year. So this is all set up in here in Holistiplan. You can see you have other options here. I'm not going to teach you how to use Holistiplan. They have tons of information on that if you're interested in this tool. But this is just to make sure they've got their wages in here. Everything else, you will want to go through here and make sure that this is all filled out appropriately. If they have other long-term capital gains, short-term gains, business income, there's all sorts of stuff you can put in here. What I want to call out is this AMT section. They've got a whole section for it, which I love. Specifically, I want to call out here that the click to solve for max feature, which I really love. So I was talking about the bargain element earlier, which we have in our lovely spreadsheet. Strategizing around that, this is where I would put that information. So incentive stock options, and then I would put that amount. Holistiplan will tell me based on a client's income, which is why that estimate is important, what the maximum bargain element someone can have is before they start to generate AMT consequences. So this is really important when we're strategizing around incentive stock options. You can see in my other 2023 scenario here, if they went with a lot more bargain element, then we actually are well above that maximum threshold. And we are going to generate a pretty hefty tax bill here of $86,000 in AMT. So that is part of how I am using, and we are using Holistiplan to strategize around the AMT. I do have clients where, their income is large enough that every year we are essentially saying, okay, how do we get as close to that threshold as we can to help exercise these options without generating a big tax bill. And so that is part of the strategy that we are doing. So the second thing I want to call out here is strategizing around this can be a little strange. Typically, what we tell folks when you exercise equity, if you want to kind of start the clock on long-term capital gains, you want to start that as early in the year as possible. So what that means is typically when we're talking to clients about this, it's, you know, January or February. So as you may know, it's kind of hard to estimate when you have equity what your income is going to be when it's January or February, and you don't know what the market's going to do, right? You take a look at 2022, and maybe you had $100 a share at the beginning of the year, and at the end it was like $20 or $30 a share. That has a huge impact on the AMT threshold if you're vesting RSUs every month or every quarter. So typically the way that I like to think about this, and I would recommend you do the same, is think about, you know, maybe going a little more conservative. So if the threshold is $99,000 for 2023, you may recommend that the client exercise up to $70,000 in bargain element in January or February, and then revisit that conversation maybe in Q3 or Q4. You have a much better idea of what the client's equity has done that year and what their total income is going to be. And then maybe you can eat up the rest of that 20K by exercising more options. It is all part of strategy conversation around taxes with that client. But you may want to, if you're starting early in the year, be a little conservative with that threshold, because if their income fluctuates, the threshold is going to fluctuate as well. The third column that I have in here is for 2024. So as you can see, if they had chosen to exercise $405,000 in bargain element, we're generating some AMT here, a good chunk of it. However, in future years, if the client does not exercise incentive stock options, and there is a difference between, this is the one, a difference between their AMT and regular tax, then they may actually be eligible for a credit. So Holistiplan will figure that out for you as well, which I really like. So let's say we come into 2024, no ISOs exercised, and we put in our, you know, hey, here's the amount that they paid in a prior year for AMT. Holistiplan will say, will take that, do their calculation and say, okay, this person qualifies for a credit for 2024 towards their taxes of $21,000. So I think that this is also very helpful to see. Some clients may be comfortable with having an AMT, you know, liability in a particular year, knowing that they may be able to recoup it in future years, and it helps them exercise their options before, let's say, an expiration date of those options. So sometimes it can be worth generating AMT and really starting to strategize around those credits to help them kind of recoup that is helpful. So that is part of how I'm using this tool, as well as on the flip side, how much credit can we get from AMT that they've paid in previous years. And then the last item I want to show you guys in Holistiplan is just down at the very bottom. And this is really the withholding calculator. So Holistiplan will say, okay, here is the total amount that is due for this particular year for federal and state, because that's the version of Holistiplan that we have. And then I can enter in the client's withholding, their estimated tax payments. That's all available to be entered in here. And then I can see kind of what's missing, right? Are they under withholding? Are they, you know, are they not paying enough in estimated taxes, et cetera? And where this really plays in with company equity, I will call out, is restricted stock units. Some companies, some wonderful, wonderful companies will allow a client to change their withholding, which is awesome. But many companies do not. So the standard withholding on RSUs for the federal level is 22%. And this client is making $700,000 a year. So their tax bracket is 35%. So we have a pretty large delta there between 22 and 35%. So if they're withholding RSUs at 22%, we have a problem from a tax perspective. And this is really where, you know, if that company does not allow them to change the withholding on their RSUs, this is where we come into making quarterly estimated tax payments to make sure that they're on track with taxes, so we're not ending up with a bunch of underpayment penalties and all of that. So this area here when I'm running all those numbers, helps me see, hey, this is obviously off, but hey, you owe this amount, they're under withholding on your RSUs, you're going to need to make quarterly payments of this amount. And that can even lend itself to a conversation around, hey, selling your RSUs as they vest is a great idea because you're already being taxed on them immediately. Then we can pay the additional tax that's due each quarter, and you can diversify, which is what we want. So that's a big bit with that. I think I've spent enough time in a list to plan, but it is a really good tool that we really like to use. So I do spend a lot of time in there for this purpose. The last tool that I want to show you guys is Right Capital. Again, like with the list plan, I'm not going to show you how to use Right Capital, but I will show you how I use it from a strategy perspective. I've put up 2 screenshots here. The first is showing, concentrated position for this particular sample client. And then the second one is the cards that you can put into Right Capital for equity purposes. So you can add their equity in there. And I am just going to switch over to Right Capital so I can show you guys this. So this is our client sample and co-client sample, lovely names that they have. The first kind of section here is that concentration. It's under investments and then concentration. This client, as we saw earlier, 80% concentration of their net worth in one company stock. They are 17% diversified. What I like about this is, sometimes things are scattered all around. They're not adding it all up. They're not thinking about, how much company equity do I really have? It is very clear right here. Right Capital is telling you, you have a diversification problem, right? So I like the visual aspect of it. And even just, hey, we've added it all up for you and it's 80%. So we need to talk about that and address that. So that's, kind of step one when we're talking about a concentrated position. The second thing that I like to look at, which I mentioned earlier, is retirement projections. So let's say, like I said, I specialize in fire planning. So let's say this client wants to retire at 45. They're like, yeah, I would love to retire in 10 years. This would be, ideal for me. And, if everything works out with their company equity or they diversify, right, then we have an 87% probability of success. Now, if I go into their profile, and I'm going to go to their net worth tab, and I'm just going to say, let's say this company fails, right? We're just going to say this isn't included. You don't get any of that. You don't get any of this. It's all out, okay? And you want to retire at 45. All right, so if we go back to the retirement tab, that's not happening, right? Our probability of success is basically nothing, which is, if that is a really big value, a really big priority for a client, it can be a really helpful way to say, hey, you have the opportunity to pursue this, right? This is something that a goal that you could reach if you diversify and we get you into a kind of an allocation that fits your risk tolerance, right? That could work for you. 87% probability of success is pretty good. But if this company fails and we don't diversify, your value of retiring early is gone, right? So that is just visualizing that for a client, saying this is what happens if it goes, right? Which is a possibility when it's one company, and especially with startups versus a diversified basket of stocks and bonds. So this is Right Capital. This is why I like to use Right Capital. I think it's really helpful to be able to show folks like this is what happens, right? If you delay on this decision and you are not willing to diversify, this is a possibility. It's a risk that you are taking. And on the flip side, maybe the company does well and it's okay, but that's the risk. So that is a part of the conversation that we like to have, and just being able to see that and helping the client like visualize what that actually means from their goals and dreams and all of that can be really helpful to help them take action. So I really appreciate being able to use Right Capital for that purpose and showing a client what this actually looks like for them if they don't take action on their equity. All right. Okay. So those are the tools that we mostly use. Like I said, we've got our CPA Todd as well, and he has been invaluable over this last year in helping us with company equity. But you don't need a CPA to do this. So that's pretty much it. If you have any questions or takeaways, anything that you want to pick my brain about, let me know. My email's up here as well, so you can reach out to me anytime. But that pretty much covers how we niche in company equity here at Citrine Capital.
Thank you, Kirsten. We have a couple of questions about the slide deck. Will we be able to share slides with registrants after the call? And I believe that's something we can do.
Sure, I don't see why not.
Absolutely. And we do have a couple of questions in the Q&A. How do you advise on exercise hold versus exercise sell? Most everyone who gets significant ISOs seems to be way overexposed to their company stock already.
Yes, yeah, that's a really good question. So it depends on the client. Typically, the way that we approach that is, speculative investments, and that does include your company equity, is 5 to 10% of your overall net worth. So for folks who have a very high net worth, that can actually be a good chunk of change. For folks who have a very low net worth, that is going to be a much smaller amount. So there is for our clients, I will tell them, hey, if you want to exercise and hold some of these ISOs for long-term capital gains or the potential growth of the company, you really believe in what they're doing, all of that, then yeah, okay, let's do it. But let's have it be, 5 to 10% of your overall net worth. And let's really focus on making sure that we're diversifying the rest of it so that you have that base to make sure that your plan doesn't implode because of this company, right? So that's how we approach it. And not every client agrees with that. It's not always an easy conversation, but that is our baseline. And then we have to work with the client and their, how they feel and what they think and all of that to work through that with them. So
Thank you so much. If a client has many different ISO grants in a public company stock that have already vested, what is your general approach for figuring out which to exercise first, last, and not at all?
yeah, that's a good question. So it kind of depends. I like to look at the exercise price. Some folks who have been at a company for a very long time might have grants that have very low exercise price, and then some might have grants that have like a higher exercise price. So if the company stock is somewhere between those, then the company stock price is somewhere between those, you kind of have to strategize around that, because if you're underwater, you're not exercising that particular grant. But from a tax perspective, you may, looking at that, you may want to exercise some of the ones that have like a smaller gap, that smaller bargain element, to get kind of more shares exercised. And if you have one grant that's exercise price is 75 cents per share, another one's $10 per share, and the stock price is 15, right? You have a much longer way to go to be underwater on the 75 cents per share than you do on the one that's $10 per share exercise price. So part of that also is, what is the volatility of that particular stock? Is it moving around a lot, right? Is it worth grabbing that $5 gain now and, maybe holding off on the 75 cents per share from a tax strategy perspective for a little bit longer? So it does depend on the company, the exercise prices, but that is what I would be looking at, right? What is the range of exercise prices? What is the current fair market value? And then what can the client afford to do? What do the taxes end up looking like if we make that decision? But there's a lot of factors that would go into that particular type of strategy.
Thank you. Is there a general rule of thumb for what happens to ISOs in a public company that expire? Are they just gone, or are they exercised automatically usually?
Yeah, my understanding on that is that you lose them if you don't exercise them. You have to take action on that. There is certainly the possibility that there's a stock plan that says, hey, these are just going to auto exercise on your behalf, but I haven't read that in a stock plan to date. So not sure if that exists in the world. But typically with an expiration date, if you don't take action, those are gone. You don't have them anymore.
Thank you. It looks like we have one more question. Oh, two more. Is now too late for tax planning? We are well over half the calendar year.
Oh, no, it is not too late for tax planning. Absolutely. It's never too late for tax planning until you get to December 31st. Then it's maybe too late for tax planning. We do tax planning for clients throughout the year. This is something that we check in on quarterly for clients. We update estimates as needed. And then if they, decide to make decisions around their equity in June or July or October, right, we can still plan around that. That is okay. So no, you can do tax planning any time of year. I don't think it's too late. I'm still doing tax planning for clients. And sometimes that comes up, you may have a secondary market offer, what they often call a tender offer for a client. I had one last year with a client that was in November, and we ultimately said, yep, we're going to take advantage. He's going to sell some shares and we're going to generate a tax bill. So be it. Now we got to strategize around it. You need to make an estimated tax payment. Here's how much we recommend you make. And that was, pretty much the end of the year. But you can't always plan for that stuff. So if it's not something that you can plan for towards the beginning of the year, or something changes drastically, or they get granted something that you weren't expecting or they weren't expecting, absolutely you can strategize for taxes throughout the year.
Thank you so much. Do you have any rules of thumb with 83B elections?
Ooh, that's a good one. So I do have a number of clients that have done 83B elections. In a lot of cases, it is where they have the opportunity to early exercise. So I have a client who did that last year. They started at a startup company and got options through that company. They exercised them and there was no gap. So we had the exercise price and the fair market value was exactly the same. So filing an 83B election in that scenario means you're not generating any taxes for that year, right? Because there's no gain there. In the case where there would be a gain, then we need to start thinking about that through Holistic Plan or whatever tax tool you are using. Start to strategize around, what tax bracket are they in this year? Do we want to try to, if they're halfway through the tax bracket, can we get them, eat up some more of that tax bracket through this, and can they generate the cash to be able to pay that tax bill? So there's some additional strategy there. Oftentimes where I see this happen is when they have the same exercise price and fair market value, and then it's like a no-brainer. If they can early exercise that and it's not going to generate any taxes, they can do that 83B, then that's a really easy decision right there.
Awesome. Thank you so much. Well, we do have one more question that just came in. How do you best plan with clients where to take the cash from to pay for the stock when exercised? Or do you do cashless exercises if available?
Yes, that's a great question. So it really depends on the client. If a client has the cash available to exercise, and I do have clients where that is the case. For example, I have a client who has 100,000 ISOs and the exercise price is 75 cents per share. They make enough money that they can just cash flow that. They can spend 10K or 15 or whatever to exercise these shares, and they can exercise large chunks and just do it out of cash flow. That is fine. They get to keep the most amount of shares, and really the more risk, more reward, all of that whole conversation, but they can afford to do that. I also have clients who can't afford to do that. And so our choice is to use that cashless exercise feature to exercise those shares. And yes, they do lose some shares that are sold off to pay for the exercise price, but ultimately for those clients, it's worth the risk of losing some of those shares to have the remainder exercised for the potential reward in the future, or now if the company is public and it's doing well. So really that depends on the cash that the client has. I will say, some clients will say, oh, I have this emergency fund. What if I just use that cash to exercise my options? Don't do that. That is certainly a conversation that I've had. An emergency fund is there for a reason, and y'all know that. It's really important to have cash set aside in case something goes wrong. So if a client makes that suggestion, I would do your best to talk them out of it, because ultimately there's a reason why we hold cash. If something goes wrong, you need that cash there. So using it to exercise options is typically not a route I would recommend folks go.
Thank you. Is the cost basis on exercise ISOs just the grant price?
Yes, good question. So incentive stock options, when you exercise, your cost basis for regular tax purposes is the exercise price per share. That is correct. For AMT purposes, it's a little different because you have the positive adjustment with your bargain element when you exercise. So that's a little bit different, and I frankly can't go into detail. I'd have to talk to Todd about that to really get more specific, because AMT is a whole other thing. But for regular tax purposes, yes, that is your cost basis. And then if you wait a year, as is typical, if you reach that long-term capital gain status, then the gain there becomes long-term capital gains. So that is the benefit. There's some tax strategy there around holding on to ISOs for about a year. There's also some risk there if you make that choice, depending on the company. And then non-qualified stock options work differently. They don't have that same function, but I'm happy to talk about that if you have questions about that too.
Thank you. For individuals in the highest tax brackets, are there strategies available to offset capital gains from stocks with losses in other areas?
Yeah, I mean, you certainly have that balance. One of the things that we do with folks who have portfolios with us where we're investing assets for them is we do tax loss harvesting. So if a client has, and this was actually very relevant in 2022, if a client has a lot of long-term capital gains in a particular company stock that they have sold, maybe early 2022, let's say, before the market really did what it did, maybe towards the mid or end of the year, we're going to say, okay, well, we've got all these gains and, their investment account is having all these losses because the market's doing what it's doing. We will try to match up some gains and losses to help with that tax bill. So yes, there is definitely some strategy that you can do around there. It depends on the assets the client has. So if they don't have it, they don't have it, but it's certainly something that we look at when folks have a lot of gains in any particular equity transaction.
Thank you. It looks like those are all of our questions. So we'll just give it a moment here in case anyone has any last minute things they want to ask. But while we're waiting, I just want to say thank you so much, Kiersten, for a fantastic presentation.
Yeah,
and thank
absolutely.
you everyone for joining us today on this Friday. Email is the best way to get a hold of you, I'm guessing, with what's on the screen.
Yes, yeah. If you have questions after this or something comes up that you didn't think of during the webinar, feel free to email me. I'm happy to chat over email. We can hop on Zoom, whatever it is, whatever you need.
Awesome. Thank you so much. And thank you again, everyone, for being here today. Bye.